Welcome to the Pro Ticker Deep Dive.
Okay, so today we're diving headfirst into, well, probably the biggest financial story out there right now. I want you to just picture this for a second.
Okay.
You're in this massive high-stakes financial casino, right? The chips are stacked, impossibly high. I mean, NVIDIA just blew past a $5 trillion market cap.
Unbelievable number.
Right. And then you add in Microsoft, Alphabet. You're looking at what, over $7 trillion combined for just those few? The energy feels amazing, almost euphoric.
Yeah, totally.
But if you listen really closely, you might just feel a tremor because, the house might actually be on fire.
That's a perfect way to put it. And that's exactly the tension we need to dig into today. The mission, really, for you listening, is to try and figure out which story holds true.
Right.
Are we genuinely at the dawn of the next massive technological revolution? One that actually justifies these, frankly, eye-watering prices?
Yeah.
Or are we just standing smack in the middle of the biggest, most concentrated financial bubble since the dot-com crash back in 2000? And it feels different this time, doesn't it? Because there's real technology here. It's not like, pets.com. These companies make real stuff, have real revenue.
Absolutely. Real products, real innovation, no doubt.
But, and this is the key thing, that doesn't automatically mean the price is right. So let's unpack this valuation paradox, because the warning signs, they're not exactly subtle.
No, they're not. In the first place, professionals always look is, what are you paying for the future? The S&P 500's forward price to earnings ratio, the PE ratio, right now it's sitting around 28.34.
Okay, translate that for us. What does that really mean?
It means investors are willing to pay over $28 for every dollar of profit they expect these companies to make next year. And historically, well, that's really high.
How high?
Alarmingly high. It's creeping up towards levels we last saw during major market tops, like the dot-com bubble. It's a definite red flag.
Okay, so the overall market valuation is stretched. But you mentioned something else earlier, the concentration. This time feels different because of that, right? The Magnificent Seven.
Exactly. The concentration risk is, it's truly unprecedented. These 7 companies, the names they now make, a staggering 35% of the entire S&P 500 index.
35%. Wow.
Think about that. If you're just a regular person investing in an S&P 500 index fund, maybe in your 401k.
Yeah, like most people.
More than a third of your money, essentially, is riding on the continued, perfect, flawless execution of just 7 companies. That's a massive structural bet, whether you realize it or not.
And look, this isn't just, some nervous bloggers pointing this out. We're hearing serious skepticism from the top, aren't we?
Oh, yeah. You've got CEOs from huge firms, Goldman Sachs, Morgan Stanley, openly talking about a potential market correction, maybe 10%, maybe 20% within the next year or two.
That's pretty direct.
It is. And then you have the ultimate bear, Michael Burry, the guy from The Big Short.
He's still at it.
He's doubling down. He's reportedly placed over $1 billion in bets against some key AI players, specifically NVIDIA, Palantir.
$1 billion betting against them.
Yep. And his core argument ties this all together nicely. He's saying, look, the technology, it's transformative, no question, but the market's expectations, they've just become completely unglued from today's actual financial reality. The price, fundamentally, is just way too high.
Okay, so we have the skepticism, the high valuations.
Yeah.
Let's shift gears slightly. Let's talk about the fuel for this fire, the actual spending, because the numbers are just almost hard to believe this is a real capital expenditure gold rush.
It really is. And the main spenders are the hyperscalers. Amazon, Microsoft, Google, Meta. They're the ones building the massive infrastructure needed for AI.
And how much are they spending?
Just those 4 companies together are projected to spend around $315 billion on AI infrastructure. And that's just in 2025.
$315 billion in 1 year.
1 year. They have to buy the chips, build out the data centers, secure the power. It's an arms race.
And that's just 1 year. If you look out further, say to 2030, the forecasts get even wilder.
Oh, absolutely. Total AI capital spending is projected to hit something like $5.2 trillion by 2030.
Okay, hang on. $5.2 trillion. That number is so big it's hard to grasp. Put that in context for us.
Right. $5.2 trillion. That's more than the entire annual economic output, the GDP of Japan.
More than Japan's entire economy, just on AI infrastructure.
Exactly.
Yeah.
So the market is pricing in this absolute certainty that this astronomical spending is going to generate equally astronomical profitable revenue, and soon.
But this is where the story gets a bit murky, right? The monetization piece.
Very murky. Let's take the poster child. OpenAI. Huge influence, Amazing tech. They generate roughly $13 billion in annual revenue, which sounds pretty good on its own.
Okay, 13 billion, not bad.
But then you look at the other side of the ledger. Their cash losses reportedly hit $12 billion, not for the year, in a single quarter.
Wait, they lost almost as much in one quarter as they make in revenue all year.
According to reports, yes. The
Wow.
current math just doesn't add up. It seems unsustainable right now.
And their spending commitments are huge too, aren't they?
Massive. OpenAI has talked about needing to spend over $1 trillion over the next decade. For them to even hope to stay viable and justify that kind of spend, their revenue needs to ramp up incredibly fast. We're talking maybe close to $100 billion a year by 2027.
Wow. That's almost a tenfold increase in just a few years, while they're bleeding cash now.
It's an extremely ambitious trajectory.
So, okay, the hyperscalers are spending hundreds of billions. The AI leaders like OpenAI are losing enormous amounts of money right now. Where's the actual return on investment? This brings us back to that really startling statistic you mentioned earlier, the Gen AI divide.
Right. There was this study, I believe, from MIT researchers that looked into this, and what they found was, well, it was pretty sobering.
Okay.
They found that while loads of companies, maybe 80% have piloted AI, and quite a few, maybe 40%, say they've deployed it.
Huh.
The main use cases are still boosting individual productivity. Things like helping write emails faster, summarizing documents, maybe drafting some code internally. Useful stuff, sure.
But not transforming the whole business.
Exactly. They're not yet delivering those big, measurable, enterprise-level outcomes that actually move the needle on the company's bottom line, the kind of outcomes that would justify these massive spending commitments.
And that disconnect, that failure to show clear enterprise ROI, that's the crux of it, isn't it?
It leads directly to the headline finding from that study. 95% of companies currently deploying AI are seeing exactly zero measurable return on their investment.
95%. Zero ROI. That just lands like a lead balloon on the whole narrative, doesn't it?
It's the core of the bearish argument. Yes, the tech is cool. Yes, it might be helping individuals internally, but it hasn't yet translated into the kind of broad, profitable business transformation that the stock prices seem to assume has already happened.
So the challenge is getting from cool demo to essential paid-for business tool.
Precisely. Bridging that gap from impressive tech to integrated business models that customers consistently pay a premium for. Until that happens on a large scale, these valuations are arguably built more on hope and that massive CapEx spending cycle than on current profits.
And that hope is being shouldered by fewer and fewer stocks, which brings us back to that concentration risk. Affects everyone with an index fund.
Yeah.
You said 35% for the top 7?
Yeah, and it gets even starker if you look at the top 10 companies in the S&P 500.
Yep.
Those top 10 now account for roughly 39% of the index's total market value.
39%.
Now, compare that to the peak of the dot-com bubble in 1999-2000. Back then, the top 10 were about 27% of the index.
But we're more concentrated now at the very top than we were at the height of the last huge tech bubble.
Significantly more concentrated here.
And NVIDIA is the extreme example within that concentration, right?
Oh, absolutely. NVIDIA's market cap alone is now larger than entire sectors of the S&P 500 added together. Think utilities, energy, basic materials, consumer staples. NVIDIA is bigger than all of those combined.
It's just hard to fathom.
It accounts for about 8% of the S&P 500's weight by itself, and over 12% of the NASDAQ 100. It's a colossal single-stock exposure for index holders.
Okay, this extreme concentration, it links into another potential vulnerability, doesn't it? This idea of circular financing.
Yes, exactly. It introduces this element of fragility into the whole system. What's really fascinating and maybe a bit concerning is this phenomenon some analysts call round-tripping of capital.
Round-tripping. Explain that. It sounds a bit like financial engineering.
It kind of is, in a way. The money essentially cycles through the same small group of interconnected companies, creating demand for each other's products.
Okay, give us an example.
Well, take CoreWeave. It's a specialized data center provider.
Yeah.
NVIDIA took a strategic investment stake in CoreWeave.
Right.
CoreWeave then provides essential high-performance computing capacity to companies like OpenAI.
Oh, okay.
And here's the kicker. CoreWeave uses the capital it raises, partly from NVIDIA's investment ecosystem, to buy massive amounts of NVIDIA's own GPUs.
So NVIDIA invests in CoreWeave. CoreWeave provides services to OpenAI using NVIDIA's investment. And then CoreWeave uses that money to buy more chips from NVIDIA.
You got it. It's a self-reinforcing loop. And we saw a similar dynamic potentially with those huge investment figures between NVIDIA and OpenAI themselves, right? NVIDIA invests billions in OpenAI.
And then OpenAI commits to buying billions worth of NVIDIA chips.
Exactly. One analyst had a great analogy for this.
Yeah.
He said it's like a furniture store owner financing the purchase of houses for customers,
Okay.
on the condition that those customers then fill those new houses exclusively with furniture bought from his store.
Right. It works great as long as people genuinely want and can afford the houses and the furniture.
Precisely. The whole chain works beautifully as long as the underlying organic demand keeps growing exponentially. But if that core demand falters, or if the technology shifts unexpectedly, that whole interconnected structure becomes incredibly vulnerable.
And we actually got a real-world taste of that vulnerability not too long ago, didn't we? With the DeepSeek shock. That wasn't just theory. The market really blinked.
It absolutely did. It was a dramatic moment. Back in January 2025, this relatively unknown Chinese startup, DeepSeek, made an announcement.
The announce.
They unveiled a new AI model they had trained. The shocking part was the cost. They claimed they did it for only about $5.6 million.
Okay. Why is that shocking?
Because comparable large language models from the big players were understood to cost hundreds of millions, maybe even billions, to train, DeepSeek claimed they got similar performance for a tiny fraction of the cost.
Ah, so the implication was,
That the massive cost, the supposed moat around training these giant AI models, could just collapse overnight. If training becomes cheap and easy, it completely undermines the scarcity argument that justifies the super high profit margins for the dominant chip makers, especially NVIDIA.
and the market reaction.
Instantaneous.
And violent. NVIDIA's stock price plummeted. It lost something like $588 billion in market value in a single trading day.
$588 billion in one day. A 17% drop. Record-breaking loss. And the shockwave hit the others, too. The broader Magnificent Seven group lost over $1 trillion in market cap that week.
Wow. So that just shows how fragile the confidence is, how tightly it's wound around this idea of continued technological dominance and high-cost barriers.
Exactly. It highlights the sensitivity to any sign that the competitive landscape might be shifting faster than expected.
And that threat of competition is real and growing, isn't it? It's
Yeah.
not just potential threats like DeepSeek.
No, it's becoming much more tangible. You've got established rivals gaining ground. AMD, for instance, has secured some major contracts. They even landed a multi-year deal to supply chips directly to OpenAI.
Okay, that's significant.
Google is also pushing its own custom chips, their TPUs, much more aggressively. And don't forget Broadcom, they have a huge share, like 65% of the market for custom AI chips, the ASICs. So the idea that one company has an unassailable long-term monopoly is looking less certain.
Okay, so beyond the fundamentals and competition, what about the technical picture? For people who follow market charts, what are the signals they're seeing right now?
Well, from a purely technical analysis perspective, the indicators are flashing caution. Many traders are seeing what's called a topping pattern.
Meaning the market might be running out of steam near its eyes.
Exactly. You're seeing these all-time highs being reached, but on weakening underlying signals. Things like declining breadth and fading momentum.
Okay, wait. Declining breadth. Can you just quickly translate that from chart speak for us?
Sure. Declining breadth basically means fewer and fewer individual stocks are actually participating in the rally. The main indexes, like the S&P 500, might still be going up or holding steady. But it's only because those few massive stocks at the top, the Magnificent Seven, are doing all the heavy lifting. If you were to strip those seven out, the rest of the market, the majority of stocks, might actually be stagnant or even falling.
Ah, okay. So it's a sign of a narrow, potentially unhealthy rally.
That's how technicians often interpret it, yes.
And what about trading volume? Does that tell us anything?
It does, and it's another potentially worrying sign. We've seen that trading volume tends to surge on the down days during the sell-offs, like that insane $33 billion daily volume during the DeepSeek crash you mentioned.
Right.
But on the up days, when the market rallies, the volume tends to be much more muted, much lower.
And what does that suggest?
To technical analysts, high volume on declines and low volume on rallies often suggests distribution.
Distribution.
It means potentially informed investors, maybe large institutions or professional managers, might be using the moments of market strength, the rallies, as opportunities to quietly sell off their holdings, getting out while the getting's good, so to speak.
Selling into strength.
Exactly. And that pattern aligns perfectly with the sentiment surveys we've seen. One recent survey of global fund managers found that 54% already believed AI-related stocks were in bubble territory.
Over half of professional managers think it's a bubble.
So the pros are nervous, the charts look tired, and the volume patterns are suspect.
So let's try and synthesize all this. We've got undeniably revolutionary technology, game-changing stuff.
For sure.
But we've got valuations that seem completely detached from current financial reality. We have immense concentration risk affecting almost every investor. And we have these fragile, circular financing structures propping things up. What does this all mean for you, listening right now, thinking about your investments over the next few years?
I think the core tension is what some people call the price of perfection. These are mostly great companies, real revenue, real innovation, as we said.
Right.
But the current stock prices aren't just pricing in success, they're pricing in near flawless execution for years to come. They're assuming smooth sailing against rising geopolitical risks, huge competitive pressures, and inevitable regulatory scrutiny. There's basically zero room for error baked into these valuations.
So for someone who mainly invests through index funds,
Yeah.
what's the practical takeaway?
I think the main thing is just to be aware of that massive concentrated bet. You're implicitly making that 35% or more in just 7 stocks. You might want to consider if that level of concentration aligns with your risk tolerance. Maybe look at rebalancing slightly towards equal-weighted index funds.
Where every company gets the same weight, regardless of size.
Exactly. Or maybe diversifying into sectors that are less directly tied to this specific AI narrative. It's about managing that concentration risk.
And what about for investors who pick individual stocks?
Well, the advice often given in tech booms is to focus on the picks and shovels.
Me.
Meaning, look for the companies that are providing the essential tools and infrastructure for the revolution, the ones with clearer, proven ROI right now. Think about things like certain data center operators, maybe the energy infrastructure needed to power all this, or enterprise software companies that actually help businesses use AI to deliver measurable value.
So focus on the enablers rather than just the companies making the biggest, boldest promises about the future.
That's one strategy to potentially mitigate risk. Focus on proven business models supporting the trend, rather than betting solely on the ultimate winners whose future is still highly uncertain and arguably already priced for perfection.
Which brings us to our final provocative thought here. Because this doesn't necessarily have to end like the dot-com crash, right? A
Right.
sudden 50% collapse.
No, and that's maybe the most important point. The biggest risk here isn't necessarily that AI fails to change the world. It almost certainly will eventually.
Okay.
The risk is that the transformation takes much longer, costs much more, and generates profits much slower than today's sky-high stock prices imply.
So not a sudden crash, but maybe something else.
I think the most likely scenario, if these valuations are indeed too high, isn't necessarily an apocalyptic plunge. It's perhaps more likely to be a long, frustrating, grinding bear market, specifically for these high-flying AI-related stocks.
Meaning they just go sideways
Where-
or down slowly.
Yeah, they could trade sideways or drift lower for years, essentially waiting for their underlying business fundamentals, their actual earnings and cash flows, to slowly, maybe agonizingly, catch up to the stratospheric valuations they reached during the hype peak. The ultimate risk isn't owning a bad company, it's paying way too high a price for even a good one.
A sobering thought to end on. The price you pay matters.
Always.
See you all in the next Pro Ticker Deep Dive.